What if I told you that right now, at this very moment, gold is forming one of the most powerful bullish patterns in technical analysis, and most investors have no idea it's happening? While the mainstream media focuses on stock market noise and crypto drama, something extraordinary is unfolding in the gold market. A pattern that historically has preceded some of the most explosive moves in precious metals history. And here's the thing that should make you sit up and pay attention. We're in the final stages of completion. Let me paint you a picture of what's actually happening right now. Gold has been carving out what technical analysts call an inverse head and shoulders pattern over the past 18 months. Now, if you're not familiar with this pattern, think of it like a coiled spring. The metal drops to a low point, rallies back up, then drops even lower to form what we call the head, rallies again, and then drops one more time to a level similar to that first low. Those three lows, when you connect them, form the shoulders and head of an upside-down person. And when gold breaks above the neckline, that connecting line across the tops of those rallies, history tells us something powerful happens next. But here's what makes this particular pattern so significant. We're not talking about some minor formation on a daily chart that might give us a $10 or $20 move. This is a massive structure that's been building since early 2024, with the left shoulder forming around $2,100, the head dropping to $1,980 in October of last year, and the right shoulder that just completed near $2,100 again last month. The neckline sits right around $2,750, and as I'm recording this, gold is trading at $2,690. We are literally within $60 of a breakout that could send gold to levels most people think are impossible. Let me tell you why this pattern matters so much, and why the timing of this particular formation is absolutely critical. In 1979, gold formed a similar inverse head and shoulders pattern. The left shoulder was around $230, the head dropped to $215, and the right shoulder formed at $235. When gold broke above that neckline at $260 in August of 1979, do you know what happened next? Within 6 months, gold had rocketed to $850. That's a 227% gain in half a year. Now, I'm not saying we're going to see that exact same percentage move, but I am saying that inverse head and shoulders patterns in gold have a historical track record that should make any serious investor pay very close attention. The technical setup is just the surface. What's happening beneath this pattern is where things get really interesting. You see, patterns don't form in a vacuum. They're the visual representation of massive shifts in supply and demand, of institutional positioning, of fundamental forces that are building pressure like water behind a dam. And right now, that dam is about to break. Let's talk about what's actually driving this pattern formation. Central banks have been accumulating gold at a pace we haven't seen since 1967. In 2024, central banks added 1,045 tons of gold to their reserves. That's the second highest year on record. But here's the detail that should make your ears perk up. In the first quarter of 2025 alone, central banks have already purchased 312 tons. They're accelerating. The People's Bank of China, which had paused its buying for a few months last year, came roaring back in January and has added 87 tons in just the past 3 months. Turkey's central bank has added 43 tons. The Reserve Bank of India has added 36 tons. These aren't small players making casual purchases. These are major central banks aggressively accumulating physical metal. And here's what most analysts are missing. These central banks are buying into the right shoulder of this pattern. Think about what that means. The smartest money in the world, the institutions with access to information and analysis that you and I can only dream about, they're loading up on gold right before this technical breakout. They're not waiting for confirmation. They're not waiting for the neckline to break. They're accumulating now, in size, because they know something that the general public hasn't figured out yet. What do they know? Let's connect some dots that the mainstream financial media conveniently ignores. The U.S. national debt just crossed $36 trillion. That number is so large it's almost meaningless to most people. So let me put it in perspective. The interest payments alone on that debt are now running at over $1 trillion per year. That's more than we spend on defense, more than we spend on Medicare. We are now in a situation where we're borrowing money just to pay the interest on the money we've already borrowed. And here's the kicker. Those interest payments are based on current rates. If rates stay elevated, or God forbid go higher, those interest payments explode even further. Now, What does any rational person do when they're drowning in debt and the interest payments are crushing them? They try to reduce the burden of that debt. And how do governments reduce the burden of debt? They devalue their currency. They inflate it away. And what happens to gold when currencies are being systematically devalued? It goes up. Not because gold is doing anything special, but because the measuring stick, the dollar, is being deliberately weakened. The Federal Reserve is trapped in a corner that has no good exits. If they keep rates high to fight inflation, they risk breaking something in the financial system, and they make the government's debt payments unsustainable. If they cut rates to ease the debt burden and support the economy, they risk reigniting inflation and destroying confidence in the dollar. Either path leads to the same destination: a weaker dollar and higher gold prices. The inverse head and shoulders pattern we're seeing in gold is the market's way of saying it understands this trap. It's pricing in the inevitable outcome. But let's dig deeper into the supply side of this equation, because this is where things get really fascinating. Gold mine production peaked in 2018 at around 3,400 tons per year. Since then, production has been essentially flat to slightly declining. The easy gold has been found. The high-grade deposits have been mined. What's left requires going deeper, processing lower-grade ore, and operating in increasingly difficult jurisdictions. The all-in sustaining costs for gold miners have risen from around $900 per ounce in 2015 to over $1,300 per ounce today. And those costs are still rising as energy prices, labor costs, and regulatory burdens increase. Here's what that means in practical terms. There's a floor under the gold price that's rising every year. Miners can't produce gold profitably much below $1,300 anymore, and as costs continue to rise, that floor keeps moving higher. Meanwhile, demand is accelerating. We've got central banks buying over 1,000 tons a year. We've got Asian consumers, particularly in China and India, buying physical gold at record levels. We've got institutional investors finally starting to allocate to gold after years of ignoring it. And we've got a growing number of wealthy individuals who are looking at the global financial system and deciding they want some insurance. The math here is pretty simple. Flat to declining supply plus accelerating demand equals higher prices. The inverse head and shoulders pattern is the technical manifestation of this fundamental reality. Now, let me take a quick 30-second detour here. Because if you're sitting on $100,000 or more in retirement accounts, this next part is specifically for you. I've put together a comprehensive guide on how gold IRAs actually work. It covers the mechanics of getting physical gold into your retirement account without triggering tax penalties, the custodian requirements, the storage rules, all the details that most financial advisors either don't know or won't tell you. It's completely free, and you'll find the link in the description below. If you're concerned about the long-term purchasing power of your retirement savings, it's worth 15 minutes of your time to understand this option. All right, back to this pattern and why the next few weeks are so critical. Let's talk about what happens when this neckline breaks. Technical analysts have a method for calculating price targets from inverse head and shoulders patterns. You measure the distance from the head to the neckline, and then you project that same distance upward from the breakout point. In this case, the head was at $1,980. The neckline is at $2,750. That's a $770 distance. Project that upward from the breakout point, and you get a technical price target of $3,520. Now, does that sound crazy? Does that sound impossible? Let me give you some context. Gold hit an all-time high of $2,789 in October 2024. So we're already just $60 away from all-time highs. And here's something most people don't realize. In inflation-adjusted terms, gold would need to reach $3,800 just to match its 1980 peak. We're not even close to the inflation-adjusted highs yet. A move to $3,500 wouldn't be some wild speculative bubble. It would simply be gold catching up to the monetary inflation that's already occurred. But let's talk about the mechanics of what happens during a breakout from a major pattern like this. When gold breaks above that neckline at $2,750, it triggers a cascade of technical buying. Momentum traders who follow these patterns will jump in. Algorithmic trading systems that are programmed to recognize these formations will start buying. Hedge funds that have been sitting on the sidelines will start allocating. And perhaps most importantly, the mining stocks, which have been severely underperforming gold itself, will explode higher. Here's a dynamic that most retail investors don't understand. Gold mining stocks are leveraged plays on the gold price. When gold moves up 10%, mining stocks typically move up 20 to 30% or more. Why? Because the miner's profit margins expand dramatically. If a miner has all-in costs of $1,300 per ounce and gold is trading at $2,700, they're making $1,400 per ounce in profit. If gold moves to $3,500, they're now making $2,200 per ounce. Their profit per ounce just increased by 57%. That flows straight to the bottom line and gets reflected in the stock price. Right now, gold mining stocks are trading near historic lows relative to the gold price. The GDX, which is the major gold miners ETF, is barely above its 2020 levels, while gold is up over 40% from those same 2020 levels. The miners are coiled like springs, waiting for this breakout to confirm that higher gold prices are sustainable. When that neckline breaks, the mining stocks are going to play catch-up in a violent way. Let me tell you about a similar setup that played out in 2008 and 2009. Gold formed an inverse head and shoulders pattern in late 2008, with the head at around $720. When it broke out above the neckline at $850 in February 2009, gold went on to rally to $1,900 by September 2011. That's a 124% gain over 2.5 years. But here's the really interesting part. The mining stocks, as measured by the GDX, went up over 300% during that same period. The leverage worked exactly as it should. Now, I want to address something that skeptics always bring up when we talk about major moves in gold. They say, but gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. And you know what? They're absolutely right. Gold doesn't pay dividends. But let me ask you this. What's the dividend on your insurance policy? What's the cash flow from the fire extinguisher in your kitchen? Some things aren't meant to generate income. They're meant to preserve wealth and provide protection when everything else is falling apart. And make no mistake, we are living in a time when that protection is becoming increasingly valuable. The global financial system is more interconnected and more fragile than at any point in history. We've got over $300 trillion in global debt. We've got derivatives markets that are measured in the quadrillions. We've got central banks that have blown up their balance sheets to levels that would have been considered insane just 15 years ago. We've got geopolitical tensions that are escalating by the month. We've got a de-dollarization trend that's accelerating as countries realize that holding dollars makes them vulnerable to U.S. sanctions and monetary policy. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with the new members that just joined, are actively working to create alternative payment systems that bypass the dollar. They're settling trade in their own currencies. They're accumulating gold specifically to back these new systems. Saudi Arabia, which has been the cornerstone of the petrodollar system since 1974, just let their agreement with the U.S. expire and is now selling oil in multiple currencies, including yuan. These aren't minor developments. These are tectonic shifts in the global monetary system. And here's what connects all of this back to our inverse head and shoulders pattern. Gold is the ultimate beneficiary of monetary system instability. When confidence in fiat currencies wavers, when the existing system shows cracks, capital flows to the one asset that has maintained its value for 5,000 years. Gold isn't someone else's liability. It can't be printed. It can't be devalued by a central bank decision. It exists outside the system, which is exactly why it becomes so valuable when the system itself is in question. Let me give you a specific example of how this plays out in real time. In 2011, when the European debt crisis was reaching its peak and there were genuine concerns about the euro's survival, gold rallied from $1,400 to $1,900 in just 6 months. Why? Because investors looked at the situation and realized that if the euro collapsed, or even if it just lost significant value, they needed an asset that wasn't tied to any particular currency or government. Gold was that asset. We're in a similar situation now, except the stakes are even higher. It's not just one currency or one region that's in trouble. The entire global monetary system is showing stress fractures. The dollar's share of global reserves has dropped from 71% in 1999 to 58% today. That might not sound dramatic, but in the world of reserve currencies, that's a massive shift, and it's accelerating. Countries are diversifying away from dollars and into gold at a pace we haven't seen since the 1970s. The inverse head and shoulders pattern in gold is telling us that the market sees this. The smart money, the central banks, the institutional players who move billions of dollars, they're positioning for what comes next. And what comes next is a repricing of gold relative to the expanded money supply and the diminished confidence in fiat currencies. Let's talk about the money supply for a moment, because this is crucial to understanding where gold is headed. The M2 money supply in the United States has increased from $800 billion in 1971, when Nixon closed the gold window, to $21 trillion today. That's a 26-fold increase. Gold has gone from $35 per ounce in 1971 to $2,700 today. That's a 77-fold increase. So gold has actually outpaced money supply growth over that 54-year period. But here's the thing. That relationship isn't linear. Gold doesn't move up smoothly year after year. It moves in explosive bursts, followed by consolidation periods. We had a major burst from 2001 to 2011, when gold went from $250 to $1,900. Then we had a consolidation and correction from 2011 to 2018, when gold dropped back to $1,100. Then we had another leg up from 2018 to 2024, taking us to current levels around $2,700. And now, if this inverse head and shoulders pattern completes and we break out above the neckline, we're likely entering another explosive phase. The pattern of these moves is important. Each consolidation period sets up the next explosive move. Each correction shakes out the weak hands and builds a base of strong holders. And each breakout attracts a new wave of buyers who finally recognize what's happening. We're at that inflection point right now. The consolidation is complete. The pattern is formed. The breakout is imminent. Now, let me address the elephant in the room. What could go wrong? What could prevent this breakout from happening or cause it to fail? It's a fair question, and any honest analysis has to consider the risks. The main risk would be a sudden, dramatic strengthening of the dollar, combined with a collapse in inflation expectations. If the Fed somehow managed to engineer a soft landing, bring inflation down to 2%, and maintain economic growth without any financial system stress, that could delay the gold breakout. But here's why I think that scenario is extremely unlikely. The math doesn't work. The US government is running deficits of $2 trillion per year. That money has to come from somewhere. Either the Fed prints it, which is inflationary and weakens the dollar, or the Treasury has to sell bonds to private investors, which means offering higher yields, which makes the debt burden even worse. There's no path to fiscal sustainability that doesn't involve either explicit default, which is politically impossible, or implicit default through inflation, which is exactly what they're going to do. The inverse head and shoulders pattern is forming because the market understands this reality. It's not based on hope or speculation. It's based on the cold, hard math of an unsustainable fiscal situation that can only be resolved through currency devaluation. Let me give you another historical parallel that's eerily similar to what we're seeing now. In the early 1970s, the US was running large deficits to fund the Vietnam War and Great Society programs. Inflation was rising. Foreign governments were losing confidence in the dollar and demanding gold in exchange for their dollar holdings. The US gold reserves were being depleted. In August 1971, Nixon closed the gold window and ended the dollar's convertibility to gold. Gold was trading at $35 per ounce at that time. Over the next 9 years, gold went from $35 to $850. That's a 24-fold increase. Why? Because the market repriced gold to reflect the new reality of a pure fiat currency system with no constraints on money printing. We're in a similar situation now, except the imbalances are far larger. The debt is far higher. The money printing has been far more extreme, and the loss of confidence in the dollar is accelerating. The difference is that in the 1970s, the US was still a creditor nation with a strong manufacturing base and abundant energy resources. Today, we're the world's largest debtor nation, with a hollowed-out manufacturing sector and dependence on foreign energy. The structural position is far weaker, which suggests that when gold reprices this time, the move could be even more dramatic than what we saw in the 1970s. And here's something that should really make you think. In 1980, at the peak of the gold bull market, gold represented 28% of global financial assets. Today, gold represents less than 1% of global financial assets. If gold were to return to just half of its 1980 allocation, we're talking about a 10 to 15-fold increase from current levels. That would put gold somewhere between $27,000 and $40,000 per ounce. Now, I'm not predicting that happens tomorrow, or even in the next few years, but I am saying that the potential upside in gold is far larger than most people realize, and this inverse head and shoulders breakout could be the beginning of a multi-year move that takes us much higher than anyone currently expects. The technical pattern is the trigger. The fundamental backdrop is the fuel. And the timing is right now. We are within $60 of a breakout that could change everything for gold investors. The central banks know it. The smart institutional money knows it. The question is, do you know it? And more importantly, are you positioned for it? This isn't about trying to time the perfect entry. This isn't about waiting for a pullback that might never come. This is about recognizing that we're at a major inflection point in the gold market, and the risk-reward is heavily skewed to the upside. If gold breaks out above $2,750 and confirms this inverse head and shoulders pattern, the technical target is $3,500. But the fundamental drivers suggest we could go much higher than that over the next few years. The pattern is about to complete. The breakout is imminent, and the implications for your wealth, your retirement, and your financial security are profound. This is not a drill. This is not hype. This is a technical pattern with a 50-year track record of reliability, forming at a time when the fundamental backdrop for gold has never been stronger. Pay attention, take action, and position yourself for what's coming next.